wrong in the earnings. I'll be the first to say it. You know, when in 155, I said fade it. You have to. It's had a huge move off 103. That was wrong. But then as it approached the 200-day moving average around 219, 220, on this show we said it has a date with 165. Go back and look a week and a half or so ago. 163.86 bounce from there. You continue to trade the stock in those ranges. It probably trends back up to 210. Then you fade the sucker again, Melms.
Here's a public service announcement. Dan is going to talk about Tesla right now. So if it bothers you that he's going to be bearish.
What does that mean?
You know, just
PSA.
I'm going to sound a lot smarter than you think, Mel. Okay, so we just talked about Nike in China, right? So why did the stock rally 7% today? Because some third-party data about some China sales. Okay, we know that they missed China sales last quarter. We know that they cut prices last quarter. We know that, we just talked about margins. We just talked about a U.S. multinational is guiding down for margins for the year. Well, guess what, people? Last year, gross margins for Tesla were 25.6%. This year, consensus has them at 22.14%. Is that incorporating the potential for a recession here in the U.S. or abroad? Is it pricing in any potential for all the competition that's coming online or any geopolitical issues as it might relate to China and Taiwan? So my point is, I actually think, flat to down EPS, which is what is consensus right now, might be the best case scenario, and margins could be under pressure further. So if this is a growth stock, if it's a margin story, and the margins and the earnings might be worse than what's expected right now, and I don't know how you could listen to everything I just said and not think that that's going to be the case, then the stock really shouldn't be rallying, in my opinion.
Guys laughing. It's almost like you're saying, I can't understand why you would listen to me and not believe everything that I just said because I am right, which may be the case. But there is a whole other argument that says, well, right now, every other EV maker, including the legacy OEMs, are also cutting price. And there is an opportunity for Tesla, the growth stock, to actually grow and claim market share in the face of weakness from what had been viewed as the oncoming competition, which doesn't seem so fierce anymore. What do you think?
Well, clearly it shows pricing power in terms of their ability to kind of reduce costs, offer discounts, and look to take market share. I'm kind of with Dan, though. Like, when you have declining margins, it makes for it flies in the face of long-term accretive growth and stock performance. So, I do think it's somewhat of a challenging backdrop. With that said, there have been so many people that have been carried out trying to short Tesla that I just refuse to do it.
You know how much money was made short Tesla last year? $700 billion.
Okay,
I'm just saying,
those people how much money was lost before then? And how many of those people
I'm not
survived
saying was made on the short side, but what I'm saying is that it went from $1.2 trillion at the end of 2021 down to, what was it, $300 billion just, 2 months ago. So what I'm saying is we got a market here, okay, and it's pretty wide, and where the stock has been trading over the last few months is really at the low end of that. And so they actually have all of the risk. Every OEM on the planet, okay, is focused on their market share in EVs. All right, so they have the most to lose. Not a $55 billion market cap company like GM, which is going to, they're going to be around in 100 years, GM, okay? Like, the jury's still out, in my opinion, whether Tesla's going to be around. And you can say, well, they're not particularly profitable and this, that, whatever. But, that's the way I think about it. Who's got the most to lose? It's not GM and Ford.